We're talking about undervalued property.
We've got Heidelberg West, where the median's significantly lower than the suburbs all around them.
Steve Ash, former investment banker, now very successful property investor, walks us through spotting potentially undervalued property in 2025 that could be a game changer for your portfolio growth. So you're looking for the underdog.
Basically finding a bit of value in the market there, looking at state level, suburb level. And there could be a 400,000 difference in some of those suburbs just to get a...
How much discrepancy are we talking?
So there's a number of things that you can look at. One good one is...
If you've ever wondered how larger scale investors look at property different to spot undervalued markets and undervalued properties, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and you're listening to my chat with Steve Ash. Steve Ash, how are you, man?
Yeah, good, Todd. Yourself?
Man, good. It's always good to see you back on the show.
Thank you for having me.
We're talking about undervalued property, undervalued markets, just buying undervalued assets in general.
Yep.
I was keen as to talk to you about this because not only do you have the runs on the board on the property side of things, but you've got a very unique background from an investment banking, superannuation management side of things, which I think gives you a unique skill set. Like we're getting all Liam Neeson on people. You've got a very unique set of skills.
Well, thanks for that. Yeah, you know, it's actually stoking my ego, so it's good. Yeah, I need that at this sort of time in my life. So yeah, I suppose, you know, we're just talking a little bit before about spotting undervalue, and I thought I'd just equate sort of how it works at Australian Retirement Trust where I used to work.
Open up a little bit. That'd be cool.
I mean, it's incredible how big the fund is now. It's 300 billion, which is massive. I think it's in the top 30 now in the world. I think it's that fast. But if you think about the variety of assets that they're managing, there'd be stocks, fixed incomes, and that's like your bonds, etc., infrastructure, property, etc. And generally, they'd have we call them weightings in the fund. So you'd have
weightings. Okay.
Yeah. So but it's a simply. I mean, it sounds a lot more complicated than it is. All that means is like 60% of the funds under management is allocated to, say, stock, 30% is to fixed income, etc.
So it's like diversification.
Exactly.
Yeah.
Exactly.
Okay.
It's just an asset mix, if you will.
Okay.
As time goes on, let's just say equities get expensive. You might want to reduce that gap or that weight, I should say, we were just talking about, maybe from 60 to 40, because they're going to maybe underperform in the long run, and so you get a smooth performance. So there's always that shifting of allocation.
Gotcha. Okay. It's making sense. And how does this transition into like being able to spot that under market value or really being able to spot something that's got that uplift potential?
Obviously, what I've just spoken about is at a macro level. There's three, as you brought in the introduction, how you can actually drill into sort of where there is value. I like to actually look at a macro level across Australia. So if we kind of sub in like the fund's exposure to, say, Australia has obviously several property markets. You've got regional and you've got capital cities. I like to look at capital cities, obviously. And so you can zero in and you can have a look, obviously, Sydney, Brisbane, Perth, Melbourne, Adelaide, etc. In that particular sort of macro view, you can look at, say, the markets that are doing really well at the moment. Currently, that's Adelaide, Brisbane, Perth. Obviously, Perth going incredibly well. But then you can actually sort of say, well, okay, what are the markets that haven't, and what are the assets that maybe haven't performed as well?
So you're looking for the underdog.
Exactly. Something that hasn't grown too much, like quite a little bit to like in the stock market and missed the market and the old sort of Ben Graham, Warren Buffett sort of way of looking at things, whereby you had like the stock market is like the industry, that's Mr. Market, and then you do a valuation on a stock. That stock might be, let's just say $50, but the market's valuing it at $40, so you can actually see that that's undervalued. So if we bring that back to the property market, we can see that Mr. Market's, and again, it's a nebulous sort of like term for property, but you can see that Perth and Brisbane are doing really well. But say maybe attached dwellings across the market aren't performing as well, and then Melbourne hasn't had too much growth. So that's an area from a macro level it's good to zoom in on.
Okay, so basically to start with, you're looking for the actual area on like a state level to go, okay, who's not performing well? And then you're zooming in from there.
Yes.
All right, so what are we looking at price-wise then, if we're going to start focusing in on Victoria?
Yeah, sure. So PropTrack has the recent Melbourne median as of recording at 914,000. So we can use that as a bit of a benchmark. We can then use, it could be an application such as Suburb Finders or another tool to then sort of look in at sort of suburbs, maybe a little bit lower than that. Sort of, I quite like to look at the ripple effect with property.
You like to stay under like state medians? Is that what you're saying as well? Or?
I do like to stay under state medians if you can, but if you've got like, I'll give a quick example, and okay, I'm not saying invest in this particular area, but you've got Heidelberg West, for example, where the median's significantly lower than the suburbs all around. There might be a number of reasons for that, but that would be something where you could look in on that and zero in.
All right, so you're looking for discrepancy between two areas?
Yes.
Okay, and how much discrepancy are we talking? Like just the most you can find?
You can look at that, but even if it's just say 100, 200,000 less, and then it's trying to find out if there is an obvious reason but for a gap there, but basically finding a bit of value in the market there. So you're going looking at state level, suburb level.
State level, suburb level. For anyone that's a little bit fresher, what would you deem like a few obvious reasons?
It's a good question. So it could be a number of things. So it could be sort of housing commission pockets that might be pulling that area down. You might be, let's just take a beachside location where you might have like close to the beach. Those properties have a significant premium over properties set back a couple of blocks back. Of
course, if you're comparing Esplanade to 300 metres down the road, you're going to get some false figures.
Well, exactly. You could be in the millions. And it could even, for example, like in suburbs in Brisbane, for example, where you have city views. I mean, there could be a 300,000-400,000 difference in some of those suburbs just to get a city view or no view.
And that's usually just going up the hill. So as far as like measuring meters, if you were just looking at a map, you could be like, oh, this is only like 100 meters away.
Yeah.
But it's like totally different geography. What's the topography?
Topography. Yeah. That's the one. That's the one. So you do have to be obviously mindful of these sort of figures. But again, it's just a tool in the toolbox just to have a look and just see if there is none of those elements. And if it does generally look like an undervalued pocket, then let's investigate a bit more.
All right, so we're starting with the country. We're zeroing in on a state to go where looks like it's undervalued at the moment. We're then using the same kind of logic to go into an area, and like you've chosen Melbourne, so we're not going regional for any of these.
Yeah.
And now it's not just looking at what's undervalued. Now it's looking at it from like a discrepancy of the comparison pretty much directly next door, correct?
Yes, exactly.
Gotcha.
As simple as that.
And if we go down even deeper, now we're looking at it from more the asset level. What's the next stage to this?
So now we're really looking. So we talked a lot macro level. So for the first two levels there, now it's finding the big assets. So we're really drilling in from a micro level. And so there's a number of things that you can look at to sort of find something that could work. One good one is looking at the disparity between, say, 2-bedroom, 3-bedroom to, say, 4-bedroom. And let's just say an example might be, say, you find a suburb, 3 bedrooms are, say, 500,000. And then the 4 bedrooms are 900,000. So So then if you find an asset, let's just say it's a house and it's got, say, that second living area or rumpus room, and it's a 3-bedroom, 1 bathroom, maybe an oversized laundry. You could maybe easily convert that to a 4x2 by converting the rumpus room and the laundry to a 4x2, and then you might get a bit of uplift and get closer to that.
So you're not talking full-on structural conversions. You're talking about how can you get creative with a good floor plan.
Creative with a floor plan, you know, and not break the budget, but then add quite significant value because there's that buffer to get to that 4-bedroom median price. So
brilliant. All right, so we're looking for a gap between, or in this example, like 3 bedrooms, 4 bedrooms. But again, it's about looking for that value disparity, really. And now we're looking at it from an asset level. Is there anything else asset level that you wanted to cover as well?
We can look at units as well. And we covered this in an earlier sort of slice. And if again, so at the macro level, we are seeing that gap. So that allows us then to maybe look at well-located townhouses and units. We can then zero in on there in particular suburbs. Now, I'm not talking about high rises, but maybe in areas where there's a bit of landlocking, you can only build up to a certain mark. And then you're looking at these more boutique blocks. So you've got a higher land to asset component in those blocks. And then again, let's just say it's a 6-pack on, say, 1,200 square meters. There's you're buying quite good land content and going in. And then it's the same sort of concept. You might have a 2-bedroom, 1-bathroom apartment, and there again might be a laundry in there which you could repurpose to a 2-bathroom, I should say, sorry. And then again, you could just create a bit of value there.
Okay, so and when you're talking, just to clarify, on the unit side of things, you're basically saying all units aren't created equal. Like you're not going into a tower of 100 apartments, that kind of thing.
No, they're all cookie cutter. There's a lot of supply. No, It's really looking at those sort of areas where just smaller boutique sort of blocks, they can't build up. Potential in the future to sort of sell that land to a developer where they might be able to develop 20 units, and the profit for each unit would be a lot better. But here you're actually getting a pretty good price on that unit when you're buying a 6-pack.
The thing that I like about this is a little bit of a stacking concept to it, because it's like you're already looking at a state that's potentially undervalued. Then we're looking at suburbs which then have a value disparity between their next door neighbours, potentially a few of them. It might even be like the real ugly duckling amongst a few
high. That's a good way of putting it. Ugly ducklings.
Yeah, ugly ducklings. And then on top of that, you're also stacking it to go, well, is there an asset type which, no matter where we are, is also maybe undervalued in itself? So then it's kind of these 3 different layers that you're putting to work in your favor to really up that chance of capital growth.
Exactly. It really is. It's just going through, like, at film Inception, when you're going through the layers. Yeah. So here you're going through the market layer into the suburb layer, and then when you know that you're buying under the median price, you're then trying to find an asset that is still undervalued, but how you can actually create that sweat equity just by, rearranging the floor plan, to your words a second ago, where you can actually just manufacture growth yourself, and then you're going to organic growth, obviously, because you're buying under what the city median is.
But you can't get too carried away, though. You need your little piece, like Inception. Just otherwise, you got to just can't start buying all the rubbish.
No, exactly.
I don't know if that works. No, it doesn't.
No, maybe not. I had to bring it just popped to mind.
It's a good film.
It is a good film. Yeah.
Anyway, I'm going to take us way off topic if I keep going down there.
Yeah.
But Steve, is there anything else that you wanted to wrap up with on this slice, mate, as far as spotting under market value, state level, suburb level, and asset level?
No, Todd, I think we've covered it all there.
Beautiful. Steve Ash from Property Strats, thank you so much for jumping on the show again, man.
Pleasure, yeah. Happy to be here.